Hello students, this is Dr. Laura Dunn, your instructor for your accounting class. There's some things I'm going to try to go over for you that might help to set the foundation that you need for this class. If you don't understand some of the things in Chapter 1, then the rest of this semester is going to be extremely difficult for you. Let's start with what is found on pages 10 and 11 in your textbook. It talks about some of the principles of accounting, and from past experience, my guess is that you just kind of zoomed through that material and didn't really take it too seriously. But there are some things on page 11 that are really crucially important when you're trying to understand accounting. The accounting principles that are listed there on page 11. First of all, the measurement principle or the cost principle. And the basic idea here is that when you're dealing with accounting, you're dealing with actual cost. It doesn't matter what somebody tells you something is worth or what it's going to be worth in the future. It has to be based on the actual cost at the time. That's because it's the only thing that you really absolutely can count on, that you can measure. And so keep in mind that you're always dealing with cost. Now, I shouldn't say always because there are some exceptions to that, but generally speaking, at this point in your understanding of accounting, just keep in mind that cost is what you use to record anything in your accounting records. The second principle talks about revenue recognition. And again, this isn't necessarily about whether or not you have to recognize revenue. It's about when you recognize revenue. So you have to recognize revenue in the period in which it is earned. Not when you receive it, because sometimes you get paid for something ahead of time, but you have to record it in the period in which it is earned. And that can be something that can be a bit of a difficult thing to measure, because if you're being paid for a project that's going to take you 6 months, you don't earn it just at the end of that project, you're earning it as you go. So you may have to record a portion of it in the first month, a portion of it in the second month, and so on and so forth. So the revenue recognition principle has to do with when you recognize the revenue, not necessarily when you receive it. The expense recognition principle is also extremely important, and it's referred to as the matching principle. This has to do with when a company records its expenses. And the idea of it matching means that those expenses have to be matched to the revenue that it is going toward. So when you have expenses that are helping you to generate revenue, those two things are supposed to be matched to each other in the same period, the same accounting period. We'll obviously talk more about that as this semester progresses. And then the full disclosure principle is pretty common sense. It's just that companies have to fully disclose any information that their investors might need to know whether or not this is a good investment. This is where a lot of companies, large companies, get themselves in trouble because they often do try to hide things. And that has led to a lot of scandals that have been in the news over the last decade or so. So to start with, those particular principles are kind of the foundation for many of the other things that we're going to be discussing. Let's turn to page 12. I'm going to let you read the part on the accounting assumptions. Those are also important, but maybe not as important as what we just discussed. However, let me mention the different types of ways that a company can be organized. There are sole proprietorships, which basically is a business that's owned by one person. There are partnerships, which isn't just two people, but can be a business that's owned by two or more people. And then there are corporations, but even a corporation can just be owned by one person. So the corporation doesn't necessarily have to do with how many people are involved. It's just the type of organization of that particular business. The main differences between these things probably comes down to what's referred to as liability, limited liability. When you're the sole proprietor, and that's the way you're organized, in terms of the IRS, that you're considered a sole proprietorship, then you don't have limited liability. Meaning that if your company fails or you go into debt as a company, then you are personally liable for those debts. So somebody can come after your house, your car, your money that you have in the bank to cover your business debts. And that's one of the main reasons that most people incorporate. Because if you incorporate, companies are not able to do that. You have limited liability. Therefore, if you go into debt and you're not able to pay your debts as a company, the creditor can only come after your business assets. They cannot come after your personal assets. And that's the key reason why most people choose to incorporate. Same thing's true with a partnership. Under partnership, you also do not have limited liability. So again, you can have the problem of somebody coming after your personal assets. And then if your partner is 50-50, then each of you can be required to pay 50% of those debts from your personal assets. So again, that's why many people choose to incorporate. Now, when you incorporate, there are some drawbacks to that. You may be taxed. It's referred to as double taxation, because you may have to pay tax on your business income, but then also pay tax on your personal income. Again, without going into an extreme amount of detail here, there are advantages and disadvantages to these different types of business organizations. You should at least have some understanding of the differences, but especially the concept of limited liability. And again, that's why most people choose to incorporate, because your personal assets are then protected from any actions against you as a business. In the next recording, I'm going to talk more about the accounting equation, but that's a good start for Chapter 1.